Assalamu alaikum and hello everyone. Today's lecture will provide useful information about how depreciation methods work. We will cover three important topics. Number one, how to record depreciation when an asset purchased mid-year. Number two, the comparison of straight line and accelerated methods, including calculation of depreciation under each method. And finally, we will discuss or determine the gain or loss on disposal under these methods. The calculation of depreciation for fractional period or when the asset is purchased mid-year. When recording depreciation, we need to adjust the depreciation expense based on the portion of the year the asset was in use. Depreciation generally is calculated for full year if the asset was purchased at the beginning of the year, suppose January. So this is straightforward. But the mid-year purchase adjustment is different. If the asset is purchased mid-year, such as in September or October or November, we only account for depreciation for the month the asset was available for use. So if the asset was purchased on September 1st, suppose, so we consider depreciation for 4 months of the year, like September, October, November, and December. If the financial year ends on December, so because the asset is in use for 4 months, so depreciation will be calculated for 4 months only. And then remember, for from the next financial year and onward, you apply the standard full year depreciation as the asset will be in use for the entire year. So only need to adjust first year or calculate depreciation, uh, mid-year depreciation for first year only, and for the next years and onward or for the subsequent years, the full year depreciation would be recorded. There are few common assumptions. First of all, treat all assets purchased before 15th of a month as acquired at the start of the month. So take full year, you can say month, consider full month depreciation if the asset is purchased before 15th of a month, like 1st of January, 2nd of January, or till 15th of January. And for the assets that are purchased after 15th of a month, consider the next month at the start date. For example, if the asset is purchased 16th January, then there's no need to consider the complete month of January. We count the month from Feb and so on. Another important concept is half year convention. So, half year convention method is used in accounting to simplify depreciation calculations for assets purchased or sold during the year. So, under this rule, uh, regardless of when the asset is purchased or sold during the year, it is treated as if it was acquired or disposed of halfway through the year. For example, for the first year of use, only half year of depreciation is recorded, no matter the exact purchase date. Like if you purchase in September or if you purchase the asset in Feb or in March, the half year depreciation will be calculated. Similarly, in the year when the asset is sold, only half of the year's depreciation is recorded. In simple word, this method ensures consistency and it is ease in depreciation calculation. So this method is commonly used in US, and the main purpose is it is easy and it is simple methods and it provide consistency. So we are going to practice all these concepts. Um, the book Financial and Managerial Accounting by William Haka Bettner, or this is also known as Meigs and Meigs Accounting, and we are covering problem 9.2a. So here's the problem. The company purchased a new machine on September 1st, uh, 2008 at the cost of $108. So $108,000 is the cost of the asset, whereas the machine estimated useful life is 5 years and its residual value or scrap value is $8,000. The important thing is the machine is purchased on September 1st, means this is the mid-year purchase. So prepare a complete depreciation schedule beginning with calendar year 2008 under each of the methods listed below and assume that half year convention is used. We have just discussed half year convention. In this method, we calculate depreciation uh, only half year, complete half year, no matter the exact purchase date, means as it is mentioned in the half year convention. So we take depreciation, um, we calculate full year depreciation and we convert it into 1 over 2, or we take half of it. So we have three depreciation methods: straight line, 200% declining balance method, and 100% declining balance method. And another thing, switching to straight line method when that maximizes the expense. So we will switch it into um, from declining balance to straight line method in this part third. So we are calculating depreciation under each of the methods. First requirement is to calculate depreciation. So we have straight line method and year 1, 2, 3, or you can say 2008, 2009. The life is 5 years. So we will calculate it for 5 years: 2009, 2010, 2011, 2012, and we will go for 2013 as well, because this is a half year convention. So in 2008 we will calculate depreciation for half year, and in 2013 we will also calculate depreciation for half year, and these from 2009 to 2012, uh, these years are four complete years. So half and half, 2008 and 2013 will make one complete year. So 5 years depreciation is required. So we will show the calculations and then depreciation expense. Then we have accumulated depreciation, and we will also prepare one column which is book value and which will be used in requirement number next. So book value. So straight line method, as the name suggests, straight line method, the depreciation is the cost minus salvage value. So the cost is, we have discussed, it is 108,000 minus salvage value, which is 8,000, and divide by useful life, which is 5 years. But as this is half year convention, so we will multiply it also with um, 1 over half, 1 by 2. So the depreciation would be, first year, the depreciation would be $10,000. So accumulated depreciation is again $10,000, and the book value, we deduct accumulated depreciation from the cost. So cost of the asset is 108,000, and when we deduct accumulated depreciation, which is 10,000, so here it is the book value. Next year, we repeat the same calculation, but without half year convention. So there's no need to calculate a half year convention, because in subsequent years, we take full year depreciation, because this asset is available for all 12 months. So we have divided by 2. So the calculation is same all years. 20,000. Next year it would be 20,000, and then 20,000, and then 20,000. And last year, half year convention rule is applied. So you can see here it is half year, half depreciation, and again it is half depreciation. Accumulated depreciation, we are adding current year depreciation with the previous one. So we have 10,000 plus 20,000. Third year, we have 30,000 previous year's depreciation plus current year, which is 20,000. Likewise, we calculate accumulated. We are basically adding up all previous year's depreciation in the current. So the next year it is 50,000 plus current year depreciation, which is 20,000, and then 70,000 plus 20,000. In the last year, we have 90,000 plus 10,000. So book value is cost minus accumulated depreciation. So cost is 108, 108. And the accumulated depreciation, here we have this column, which is O 05. So we deduct O 05. And you can see we have the book value remaining, which is equal to the scrap value or salvage value of the asset. Here you can see this is equal to, so the remaining book value or remaining after the end of the useful life should be equal to its residual value. So the next method is, we have this straight line method. Next method is 200% declining method. So we are using a 200% declining method. D part 200% declining method. Decline. So in 200% declining balance method, we need to calculate a rate of depreciation, which is, you can see, 1 divided by useful life. So useful life is 5 years. Uh, In this way, we calculate straight line method rate. And then we multiply it by 2 because this is 200% declining balance method. So we multiply it by 200%. So this is the way of calculating rate for 200% declining balance method, which is 40%. So this is the rate which we are going to use while calculating depreciation under 200% declining balance method is 40%. So here, this is the same way we will calculate calculations. We have uh, now calculation is a bit different. We have 108 multiplied by the rate which we have calculated 40%. So the cost will multiply by 40%, which is 40%. In this way, we calculate the depreciation, but half year convention is mentioned. So again, we multiply it by 1 over 2. So in this way, we calculate depreciation first year. So you can see this calculation. So this is the depreciation year one, $21,600. So accumulated depreciation is again uh, $21,600. And the book value is 108. This is the total cost of the depreciation, and we will deduct the depreciation, which is O13 or accumulated depreciation. Accumulated from the cost, which is 108, $100,000, we deduct accumulated depreciation, which is 21,600 to get the book value. So next year, the change is we multiply book value, which is 86,400 with 40%. So this is the calculation. Here we calculate and we take full year depreciation for the subsequent years. So this is the depreciation, and then accumulated depreciation is 21,600 plus we add all previous, which is 34,560, and the book value is the cost minus your accumulated depreciation. The next year, the book value is, you can see 51,840. So here we have 51,840 your book value, and we multiply it by 40% to calculate depreciation. So depreciation third year would be 20,736. So accumulated depreciation is add all previous depreciation with the current year depreciation. So previous year 56,160, we add current year, which is 27,36. And the next year, the book value of the asset is 31,104. So the book value of asset here we have 31,104. Then we calculate depreciation by multiplying 40%. So this depreciation, accumulated depreciation would be previous year depreciation 76,896 plus current year depreciation, which is 12,442. Next year, We take the book value, which is 18,662, and the depreciation will be this one, which is 7464, or you can say 7465. We can write down exact 7465. And here it is 12442. So this is 12442. So we calculate accumulated depreciation, which is 89. The previous year depreciations are 89, 388, and plus current year depreciation, which is 89,338. The current year depreciation is 7465. So here we have the book value, which is 11197, and then we take now. Remember one thing, for the current for the last year, we this it is mandatory to have your you can say this residual value should be the remaining book value. So the residual value is 8,000. So for calculating this 8,000, we simply take, instead of calculating this whole method of book value applying a 40% rate, what we do, we simply have, you can say, the depreciable value, which is 100,000, or you can say cost, which is 108,000, minus residual value, which is 8,000. In this way, you will get depreciable cost. And then we will deduct the accumulated depreciation, which we have, uh, you can say 86,803. So we deduct it 86, we have 96,803. So we deduct 96,803 from here. So this is 3197. So this is the so 3197 is the depreciation here. So when you add the current depreciation in the previous one, which is 96,803 plus 3197, you can see the accumulated depreciation is similar as the depreciable cost, because the cost of the asset is 8108. So when you deduct uh, residual value from 108, then this is your accumulated depreciation, or in other words, this is depreciable cost. You get book value, remaining book value is 8. Like in this way, here you can see the remaining book value is 8,000, and here also we have remaining book value, which is 8,000. So next method is 150% declining balance method. So now we are calculating. The method is same almost, but the rate is different. So third method is 150% instead of 200%. So this is 150%. There's a need to calculate the rate of depreciation. What we do, we have, first we calculate depreciable rate with the straight line method, which is 1 divided by useful life. And then we will multiply it with the this 150% declining balance rate. So which is multiply 150% of declining rate. So 30% is the depreciation rate in the third method, which is 150% of declining balance method. So as it is a half year convention, we take Here, instead of 40%, we take 30% and multiply it by 1/2. So the depreciation is 30%. So this is 216. Here we have is 16,200. So depreciation is 16,200 first year. The book value is 91,800. So we change it by 91,800. And the rate of depreciation is also 30%. So we take it this calculation for the calculation of depreciation, which is 27,540. So accumulated depreciation would be previous depreciation. You can see 16,200, and then we add current depreciation, which is 27,540. So next year, the book value is 64 to 60. So we take next year the previous year book value, which is 64 to 60. And the rate of depreciation is 30%. So we calculate depreciation expense, which is 19,278. Then we have accumulated, which is previous year depreciation, which is 47,340, plus current year depreciation, which is 19,278. So here we have 44,982. This is your book value. So in 2011, it is 44,982. Multiply the rate of depreciation, which is 30%. So the calculation is, can say, 13,494.6. So if we can say that it is 34,495. So this is 13,495. Then the accumulated depreciation would be add all previous year's depreciation, which is 63,018, plus the current year depreciation, which is 13,495. So here we have accumulated depreciation, and the book value is 31,487. Now, the next thing is, as it is mentioned here, that switching to straight line when that maximizes the expense. So here we can see that here you can see we are switching this method to the straight line method. So for straight line method, we need to calculate whenever we switch from one method to another method, we need to calculate the book value. So book value is mentioned. Straight line method, book value is here 31,487. So the calculation would be in this way, that we have cost or book value. So book value is 31,487 minus, because a straight line method formula is cost minus your residual value, which is 8,000, and divide by useful life. So the remaining useful life is 2 years. So we divide it by 2 years. So here in this way, we can calculate depreciation straight line method. So which is 11,744, because it is point 0.5, so we can round it. 11,744. So accumulated depreciation is again all previous year depreciation, which is 76,512 or 13. We add the current year depreciation, which is 11,744. So here it is your um, book value. The method is same next year, divide by 2. So next year it is 11,743. So the accumulated depreciation would be all previous years depreciation, which is 88,257. Then we add current year, which is 11,743. So here you can see uh, the residual value is equal to the remaining book value. So it should be the same, and you can see it is same under each of the method. This is a straight line method, 200% declining balance method, and this is 150% declining balance method. So all are same. So this is the first requirement, that prepare complete depreciation schedule. As it mentioned, complete depreciation schedule. So we calculated a complete 5 years depreciation. The next requirement is which of three methods computed in Part A is most common for financial reporting purpose. So for financial reporting purpose, the company may use straight line method, as this method results in the least amount of depreciation expense in the early years of the asset's useful life. In other words, you can say that this method spread out the cost evenly, making it simple, or it is predictable. You can see here we have the same depreciation each year, 20,000, 20,000, and so on. Here we have depreciation, higher depreciation in early years, and the depreciation is declining in later years. So this depreciation through straight line method is simple and straightforward. It is practicable and predictable. So there are chances that the company use a straight line method for financial reporting purposes. The next requirement is assume that the company sells the machine on December 31st, 2011. This one, at the end of this 21, for 28,000 cash. So compute the resulting gain or loss from this sale under each of the method used. So does the gain or loss reported in the income statement have any direct cash effect? So let's see. First, we are going to calculate requirement number C is to calculate gain or loss under each depreciation method. So the procedure is we have cash proceeds, we deduct book value to get any gain or loss on disposal. So we have three methods. First of all, we have straight line method, then we have 200% declining balance method, and then we have 150% declining balance method. So the cash proceeds are same whether we use straight line or declining balance method. So this is $28,000 in each case. And then we deduct book value. The asset selling date is 31st December 2011. So on 31st December 2011, the book value of the asset is here. We have the date. You can see the date. So the book value is $38,000. So in straight line method, we deduct dollar 38,000. So as we have more book value as compared to the cash received, so the company has loss on disposal of asset, and the loss is 10,000. So this is the loss. Here we have loss on disposal under straight line method. So this is the straight line method. The next one is 200% declining balance method. So you can see on December 31st, 2011, mm, book value is 18,662. So we deduct dollars 18,662 in order to get gain or loss. So we have gain on disposal of assets. Why it is gain? Because you can see the book value of the asset is less than the cash proceeds. So you receive more cash as compared to the book value. So this is this is gain. So here we have gain on disposal of asset, and the next method is 150% declining balance method. Here you can see the book value at this date is 31,487. So we will deduct dollar 31,487 and then calculate gain or loss. So we have a gain. You see the amount is negative, which means that we have loss on disposal of asset. Why it is loss? Because the book value is higher than the cash proceed or the cash received. So if you receive more cash as compared to your book value, then you have gain. Like in the case with the 200% declining balance method. And if you receive less cash as compared to your book value, then um, the loss will be occurred, like in the case of a straight line and 150% declining balance method. So that's it from this problem, which is 9.2a. Take care, class.